So it would be easy to be pessimistic right now, and I would actually I would have understood it if the vote turned out, you know, the opposite of what it did just a few moments ago. I was amazed to see what a huge majority of folks were saying they were optimistic about the economy. All right, so let me give you some reasons to be optimistic. Although it sounds like I don't need to give you reasons. You're there already. So let's go through it quickly. One is that, broadly speaking, corporate profits are very strong right now. This chart shows corporate profits, the growth rate of corporate profits nationwide. It's the green line on the right-hand axis, and the key thing is that I compare it to job growth with a three-quarter lag between them. In other words, profit growth leads job growth by about 3 quarters. When profit growth rises and rises substantially, we almost always see a turnaround in job growth. And we are there. You can see the comparisons are actually a little easy because profits a year ago, a year and a half ago or so were pretty weak. But profit growth is soaring and job growth is heading back up. It is in positive territory. And I think this is actually one of the most positive factors in the economy right now. What's interesting, when you look at corporate profits are stronger in terms of those profits that are being earned abroad. This chart shows profits earned domestically by non-financial corporations on the orange bar on the left-hand orange line. And then you can see total, which is about almost twice as high, the green bar, and that includes both profits earned overseas as well as domestically earned profits. It indicates the importance of the growing global economy and the increasing interlinkages with the global economy. Again, as Mike mentioned, it's become a critical part of our economy and actually a critical part of the Sonoma County economy. One thing when Ben and I were chatting last night, one of the comments I made was that the Sonoma County economy, for a small economy, is remarkably open. Because so many of the key industries and key clusters either compete in global markets or depend on global markets for their sales and their profitability. It's across the board, really, in terms of travel and tourism, with foreign visitors coming, with the wine industry, of course, which has become so global, with the technology industry, you name it, across the board. The global economy is very, very meaningful here in Sonoma County. And so given that profits are rising both in terms of domestically earned profits and internationally earned profits, that is a very good sign for the county here as well. Another point of optimism is that the shift in household debt service burdens is moving very quickly, that households are deleveraging their portfolios rapidly and coming out of the mountain of debt that was piled up during the boom in the housing market and the boom in consumer spending, a lot of that fueled by spending using credit and spending beyond one's means. Now, when you have a downturn here, which is illustrated here by the orange line on the left-hand axis, which is just the total debt outstanding. This data comes from one of the credit bureaus, Equifax, which we maintain a database with. Or on the green line, which is simply a count of the number of bank cards outstanding. You can see how quickly things are changing, particularly for consumer debt. For total debt, which includes mortgages, of course, is not falling quite so much, but still falling. And what that means is that the debt service burden for households is falling very quickly as well. The debt service burden, this is data that comes from the Federal Reserve. The debt service burden is the green line on the left-hand axis. Or actually a better measure is the so-called financial obligations ratio, which also comes from the Federal Reserve. And this includes not only outright debt, but includes leases and such. So car leases, apartment leases are included in this as well. And you can see that the debt service burden is coming down from a record high. And if this trend continues at the same pace, we'll be back almost to where we were back in the early 80s in terms of consumer debt service burden. Now, in a way, you know, this is good news and bad news. The bad news is a lot of the debt service burden, the lowering of the debt service burden is involuntary, you know, through bankruptcies, through mortgage defaults and the like. And so it's painful. Clearly, it's been painful as the economy has recovered. We've seen this in terms of a very slow pace in the turnaround of consumer spending and the like. But once the economy is back on its feet, once job growth begins to accelerate more quickly, the combination of an improved economy and this lower debt service burden means that not only will there be a willingness to spend, but there'll be an ability to go out and spend on some of the things that the households have wanted to buy for a long, long time. In fact, I think there is evidence of a fair amount of pent-up demand for consumer spending. We're beginning to see it in the travel and tourism industry and here in Sonoma County, both in terms of corporate travel and in terms of business travel. The numbers that I was hearing last night were very, very good in terms of improving occupancy rates in hotels here, in the improving count of visitor arrivals here in the county, all looking very, very good. And I think one can say that that is probably one of the strongest aspects of economic recovery right now in the county today. And I think it will continue. There will be a little bit of headwinds, perhaps, from, again, from high oil prices, but I don't think that's a really severe issue at the moment right now because of the extent of pent-up demand for consumer services and consumer spending. For the banking industry, we're seeing that credit quality is also improving very quickly. And this is, again, data from Equifax. The orange line is the 30 to 90-day delinquency rate for mortgages. The green line is the same for all consumer credit. You can see that the pipeline of delinquencies is narrowing very, very quickly. And this will be good for the economy and also good for the banking system as well. The banking system seems to be healthier, seems to be functioning, not only in terms of a decrease in new delinquencies, but just the fact that many large banks in the country actually have been able to successfully recapitalize after the financial crisis. Part of it had to do with federal policy, in that the major banks in the U.S. were forced to go through some very severe stress tests a couple of years ago, and they came out of that with some good benchmarks that they had to meet in terms of capital requirements, and they met them. And so the banking system is functioning better here than it is in Europe right now, and that is one factor that I think will help this economy to grow. The fact that we have a fairly strong and a well-functioning banking system can be seen in terms of the senior loan officer survey that comes out of the Federal Reserve. This is a survey that's done about every 6 weeks and asks loan officers around the country about their lending standards, whether they are easing or tightening lending standards. The green line on the left-hand axis is simply the net number, the net share of respondents that say they are willing to make a consumer loan. And you can see that green line has gone up very, very sharply over the last year or so. The other line is sort of, you have to read it kind of backwards. That is a question of whether banks are tightening standards for commercial and industrial loans to small businesses. That's on the right-hand axis. And if things are getting better there, that line should be going down, and that line is down. That is below the zero, meaning fewer bankers are tightening standards for C&I loans than are easing lending standards. So the credit system seems to be working. Credit is slowly getting back out into the economy. Credit, of course, is a grease that helps the wheels of the economy turn. And I think this is a very positive aspect for the economy, broadly speaking. Now, we have to take into account that of course, there are risks in the economy. And the risks almost seem to take a heightened role because of the fragile nature of confidence among consumers and confidence among businesses. They're worth noting. I'll try to go through these very quickly. One is oil prices. That they have been so volatile, and they rose quickly. As I said, unexpectedly this year. This chart shows the dollars that are spent, that consumers spend on gasoline, and you can see that earlier this year we almost got back up to where we were in 2008 when crude oil was at close to $150 a barrel. Now, fortunately, oil has gone down. I was happy to see that driving up here from San Francisco, gas is below $4 a gallon now. That's heartening to see. And crude oil is back down to about $90 a barrel. $90 a barrel, that's something that the economy can manage. We're okay at $90 a barrel. And if we stay within the $90 to $100 benchmark for West Texas Intermediate crude oil, I think we're okay in terms of the impact of the energy, cost of energy on the economy. The other, one other near-term risk is simply that there could be some further declines in house prices, and that is because of the pipeline of mortgage foreclosures that still had to be worked through the housing market. This chart shows the REO inventory, the real estate-owned inventory owned by banks in the country, and it's color-coded by the ownership of the various, whether they're banks, Fannie Mae, Freddie Mac, FHA, and the like. And you can see that through late 2010, that inventory was rising. That inventory eventually does have to find its way back onto the market. The more distressed sales there are in any housing market, of course, the more pressure there is on prices to falter further. And we do think that nationally there will be a bit more of a decline, perhaps about a 5% decline in house prices this year, and then stability in 2012. And that very much mirrors our forecast for Sonoma County. That I still see, I think there's no way to avoid that downward pressure from distressed sales through the second half of this year. And we'll see prices struggle through the second half of this year. But my guess is that we get into early 2012 and there's some stability finally in the housing market. And I also think that once there is stability, once that there is a palpable feeling that the housing downturn is over, I think there's a good chance that we could see some pretty strong demand for housing. Again, there's a lot of pent-up demand for housing. There's a new generation growing up that needs housing. There have been many households who have put off the decision to buy a house because either they're unsure about house prices or it's been tough to get a mortgage loan. My guess is that over the course of the next year, lending standards will ease a touch on mortgage lending as well. And so I think this is a near-term problem, something we have to be cognizant about. At least the data is out there to help us understand what is going on. It's not a shock or a surprise like, say, oil prices if something out in the if the Middle East flares up again and we see prices in oil rise. That's something we can't really predict. At least we know what's going on here. The third final downside factor, and Mike actually addressed this pretty clearly, is the difficulty in state and local government finance. And it's quite remarkable to see. This is nationally simply the growth in real growth in state and local government spending. And really it never slows. We had one, or falls. We had 1 year back in the 80-81 recession where local and state government spending fell, but that was the only time. And we've seen it now 2009 and 2010, 2011, and our estimate is 2012. We'll see another downturn in state and local government spending. And I think that's pretty clear. And with the new fiscal year for most areas starting next week, budgets are, for the most part, in the book. And budgets are tight, as they are in Sonoma County, and we have another year of difficulty. The positive side of this is that at least for state governments, state government revenue is rising now. Across the country, state government revenue is up over the year 6, 7, 8%, depending on where we are. It's actually pretty strong here in California. I think once we get through the fiscal fiscal year 2012, state and local government revenue will be a much smaller issue. It'll be more difficult at the local level than the state level because of the local government's higher reliance on property taxes. So, of course, house prices have to stabilize before local government revenue can really, broadly speaking, stabilize. But I think next year, this fiscal 2012, second half of 11, first half of 2012, will be the toughest. And when we get into fiscal 13, there will be a little bit of breathing room for both state government and for local government. The economic recovery is broad. This is a map that shows where we see the business cycle across the 50 states in the U.S. Green means recovery. California is in recovery. Red means recession. There's only one state still in recession, and that is Nevada. The Las Vegas economy still is suffering, although actually, even like Sonoma, visitorship and their gaming and such are improving in Las Vegas. And my guess is that Nevada actually is out of recession maybe 6 months down the road or not.